Hi everybody, and welcome back to video number 3 on chapter 15. And when we left off, we were looking at the summary of the journal entries that we just went through. So in number 1, we were bringing raw materials into the plant. So we've acquired them by debiting raw material inventory and crediting accounts payable to pay for that. Now for direct materials that we used, we're going to charge those directly to work in process inventory here and credit raw material inventory to reduce that inventory from raw materials. Then for direct labor that we use, we're going to debit work in process inventory and credit our factory wages payable. And then for indirect materials that we use, we're going to put that in factory overhead account. And that's going to be a debit. An actual is going to be the debit. And then the raw materials inventory is going to be reduced for those indirect materials that we take out of raw materials inventory. Then for indirect labor, we're going to debit factory overhead as an actual and credit factory wages payable. And then we're going to charge work in process inventory with a debit and credit factory overhead for that which we applied, 160%. I'll come back to that in a second. And then for factory overhead actual here, again, we're going to debit factory overhead account and credit the actual overhead costs in those categories shown. In finished goods inventory here, we're going to complete some jobs. So we're going to move them out of work in process inventory with a credit and into finished goods inventory with a debit. Our cost of goods sold represents those that we have actually sold to customers, so we'll debit cost of goods sold and credit finished goods inventory. And as we make a sale, we'll debit accounts receivable. Normally we don't use cash in big companies. We'll debit accounts receivable and credit sales. So let's come back to this account here called factory overhead. Now here's all our actuals over here, and here's what we applied. So we didn't apply quite enough here. That's why we have a $200 balance there. This needs to be 0. Okay? So you see how that works. This credit is what we apply. These are our actuals. Okay. So our schedule of cost of goods manufactured. Here's our direct labor, direct materials that we used. Here's our direct labor. Here's what we applied. That's $67.20. So our total manufacturing costs represents $12,720. We're going to add any beginning work in process inventory. In this case, we didn't have any. So our total cost of work in process is $12,720. We'll back out the ending work in process inventory, and that tells me what we have actually completed and moved as finished goods into finished goods inventory, $9,300. And as you see, there is the $9,300 that we've moved out of work in process and into finished goods inventory. Okay. Now, our income statement, we're going to have the sales, our cost of goods sold, gross profit, selling, and G&A expenses. Our net income is $600. We have our 3 ending balances in raw materials inventory, work in process inventory, finished goods inventory, and then our total inventory, $10,820. And you can find those balances here as well in our ending inventory balances for work in process, finished goods, and raw material inventory. Okay, last, we got to get rid of that $200. We're going to close over-applied and under-applied factory overhead. And here is a general look at that. As I showed you just a second ago, in that factory overhead account, our actuals are going to be our debits, and our applied is going to be our credits. In a perfect world, we want that to zero out. But I've been doing this a long time, and I've never had it hit perfectly yet. So, what we do here, if our actual is greater than our applied, that means we have not applied enough, and it's called under-applied overhead. The jobs, therefore, don't have enough costs in them. That's an important concept. The jobs would be under-costed because we haven't applied enough overhead into those jobs. So we correct it in a macro sense by debiting cost of goods sold and crediting factory overhead. That will zero out that account when we do that here in a second. But it is possible that we over-apply in this case, and in that case we put too much cost into our jobs. And so we do something a little funny here. We have a negative expense or cost to cost of goods sold with a credit, and debit to factory overhead. So the journal entry here, they're going back to this factory overhead account, and they've labeled that $200 now as under-applied, because we haven't applied enough overhead here to offset all these actuals. So the way we correct for that, as we just showed you, was to debit cost of goods sold and to credit factory overhead. And that closes the under-applied overhead account. When I do that credit to the factory overhead here, that offsets this debit of $200 that's under-applied. Very important concept. Make sure you understand that. All right, job order costing of services. Here, job order costing does apply to service companies. Service companies don't have, of course, raw materials or finished goods, or for that matter, any inventory for the most part. They have supplies, but these may be considered as overhead. Direct labor is used to apply that overhead, just like we did, and typically we're going to use some different accounts here than we do in a manufacturing company. So in this case, such as maybe services in process inventory or services overhead. And we take service costs, which are labor and overhead. Notice there's no inventory there. And as we complete the jobs, we bring them through the services in process inventory. We complete those and bring those over. If we don't complete them, they stay in services in process inventory. And then, of course, if we sell these, then we would reduce those costs on the income statement. Okay, now apply job order costing in pricing of services. Normally, I don't like to price for services based on my costs. I'm going to price my services based on what the market will bear. So in this case, though, often cost does greatly influence our pricing decisions. So here our service providers also use job order costing for this effort. The cost for each individual job is tracked or are tracked separately. These total costs include labor and overhead, no inventory, of course. And they show this example of some designers and some staff hours and our total direct labor, but we also have some overhead based on some hours that are not direct labor hours. And we've costed those out at $11,232. And that gives us our estimated job cost of $17,077. Okay, our gross profit ratio, that's going to be the service revenue less the cost of those services divided by service revenue. Same formula that we use generally for manufacturers. And here, the service providers also use job order costing and the cost for each individual job tracked separately, and the total cost include just labor and overhead. All right, that concludes Chapter 15. Please study especially this chart here. You want to really understand the flow of costs from raw materials through factory overhead, how that factory overhead is relieved and charged, and then how that moves then to work in process inventory, to finished goods inventory, and finally out the door as a sale and cost of goods sold. All right. And when we come back, we will start with Chapter 16. Until then, bye for now.